Oil production beyond sanctions. The OFAC General License 41B for Chevron's operations in Venezuela expired on May 27, 2025. Its expiration was anticipated to cut off the country's oil revenue, aligning with virtual terrorists' goals. Tammy Bruce, on May 27, 2025, called the expiration a happy ending license day during a State Department briefing. Her statement suggested a complete end to Chevron's operations, framing it as a policy win for the Trump administration in support for a regime change. However, Reuters reported on May 27th that Chevron received a new specific license for limited operations. This license allows Chevron to maintain a $7 billion in assets but prohibits exploration, directly contradicting Bruce's narrative of a full cessation and revealing a policy inconsistency. The contradiction between the State Department's messaging and the Treasury's actions creates confusion. Bruce's statement implied a hard-line stance, while the new license reflects a pragmatic approach, possibly to counter China's influence, as Chevron's CEO noted. If the United States doesn't use Venezuela's oil, China will. This inconsistency impacts public opinion in Venezuela, where United States contradictions are noticed. Regime change factors are frustrated by mixed messaging, as they expected a tougher stance. Need for clarity is evident, as unneeded controversy undermines United States credibility. Despite its alleged confidentiality, Office of Foreign Assets Control (OFAC) is requested to publish the new license to resolve this contradiction, reflecting the broader change of maintaining coherent United States foreign policy. Chevron had operated in Venezuela under OFAC licenses despite sanctions. Licenses such as General License 41B allowed limited operations, balancing economic interests with political pressure. Chevron's presence had provided revenue to PDVSA, complicating United States efforts to isolate the country. Abstentionists rely heavily on United States support to delegitimize the Venezuelan government while boycotting elections. In contrast, participationists engaged, securing 29 seats at the National Assembly. This division weakened their regime change expectations. Venezuela countered the United States pressure by deepening ties with China, Iran, and Russia, key allies in evading sanctions. China became Venezuela's largest oil buyer, while Russia provided military and economic support. These partnerships stabilized the Venezuelan government, reducing the effectiveness of United States sanctions and complicating abstentionist strategies. Regionally, President Nicolás Maduro found support from leaders like Colombia's President Gustavo Petro and Brazil's President Luiz Ignacio Lula da Silva. Their backing countered the United States-led isolation efforts, further isolating abstentionists, whose ability to rally international pressure against Venezuela remains limited. Venezuela's economic alliance with China, military alliance with Russia, along with opposition's participation in regional and National Assembly elections, highlight the ineffectiveness of exerting pressure through sanctions. Domestically, the opposition faces significant challenges, with public support below 20%, according to most recent election results. Protests like the January 9th 2025 demonstrations saw low turnout, reflecting disillusionment. People no longer risk their lives for leaders perceived as detached, often in exile, highlighting the movement's struggle to maintain relevance. Edmundo González's exit from Venezuela's opposition leadership in early 2025 due to illness created a vacuum. His United States recognition as president in January 2025 had briefly unified abstentionists. By June 2025, Venezuela is no longer a global headline, overshadowed by other crises. From 2019 to 2023, its crisis-dominated news with Juan Guaido's rise and United States sanctions. Now, global focus has shifted, reducing the visibility of Venezuela's plight and the opposition's struggle. Competing crises include Ukraine's war with Russia, Gaza's conflict, Iran's nuclear tensions, Taiwan's disputes, China tariffs, and Pakistan's instability dominating headlines. These issues divert international attention from Venezuela's political and humanitarian developments. Abstentionists' strategy of leveraging international support to isolate the Venezuelan government yields diminishing returns, weakening their position. Tammy Bruce's Happy Ending License Day statement suggested a full end to Chevron's operations in Venezuela. However, Reuters on May 27th reported a new specific license allowing minimal operations, contradicting the State Department's narrative. This inconsistency was also noted by Fox Business on May 28th, fueling public confusion. Transparency would address the contradiction between Bruce's statement and Treasury's actions, calming public opinion. Unneeded controversy harms United States credibility. OFAC is able to maintain confidentiality under the Freedom of Information Act 5 United States Code 552-31 Code of Federal Regulations 1.5, whose exemption 4 specifically protects confidential commercial information such as trade secrets and commercial or financial information that is both confidential and obtained from a submitter. These laws protect sensitive information such as proprietary details in Chevron's license. However, public interest in resolving confusion outweighs confidentiality concerns in this case. Florida's diaspora is frustrated by the mixed messaging. They expected a hardline stance against Venezuela, but the new license signals pragmatism. Transparency could reassure this community. General License 41B expired on May 27th, prompting Bruce's happy ending statement. Yet, a new specific license now allows Chevron to maintain $7 billion in infrastructure and joint ventures with PDVSA, contradicting the State Department's narrative. Fox Business on May 28 confirmed the new license scope. Chevron can maintain assets but not explore or produce oil. Chevron's CEO Mike Wirth warned, if the United States doesn't use Venezuela's oil, China will, highlighting geopolitical stakes. This aligns with Reuters' May 27th report on the narrow authorization. Bloomberg, also on May 28th, reported the license for limited operations, consistent with prior sources. It noted the license might pave the way for United States-Venezuela bilateral talks, further contradicting Tammy Bruce's hardline stance. This development underscores the ongoing tension between State and Treasury Departments' messaging. OFAC tends to maintain confidentiality under Freedom of Information Act, suggesting a full license publication is unlikely without significant public pressure. The State Department has not clarified the contradiction. Tammy Bruce's silence on the new license perpetuates confusion. This lack of alignment continues to fuel controversy in Venezuela and South Florida, impacting United States credibility and necessitating further analysis of transparency's potential impact. Publishing Chevron's new license could calm public opinion, where confusion reigns. Transparency would clarify whether Chevron's role is limited to asset maintenance or petroleum transactions continue via joint ventures with PDVSA. Aligning state and treasury messaging would restore United States credibility, undermined by Bruce's happy ending claim versus the new license. This clarity could also weaken the abstentionists' over-reliance on the license expiration narrative. However, OFAC faces challenges in disclosing the license, given confidentiality protections under FOIA and 31 CFR 1.5. These laws safeguard proprietary information, and full disclosure might harm Chevron or United States foreign policy interests. A limited statement confirming the license scope could balance transparency with security. Venezuela's oil transactions are already pivoting to China, Venezuela's largest oil buyer, as Chevron CEO Mike Wirth warned in Fox Business. This could offset the economic pressure intended by limiting Chevron's operations. OFAC might opt for a middle ground, issuing a public statement without revealing proprietary details. Growing media coverage, like Bloomberg's reports, may pressure OFAC to act. Transparency's benefits should outweigh the risks, potentially stabilizing United States policy perception in this crisis. Bloomberg's article on May 28, 2025, confirmed Chevron's new license for minimal operations in Venezuela in alignment with Reuters and Fox Business reports, detailing Chevron's $7 billion asset maintenance role. A new element is introduced. The new specific license might lead to the United States-Venezuela bilateral talks. This suggests a pragmatic United States shift, aiming to counter China's influence, as Wirth noted. Such talks would prioritize strategic interests over isolating Venezuela as a significant policy pivot. This directly contradicts Tammy Bruce's happy ending license day statement from May 27th, which implied a full end to Chevron's operations. The State Department's hardline narrative, backed by Marco Rubio, aimed to reassure regime change narratives. Bilateral talks signal a softer approach, undermining the isolationist stance. The contradiction impacts United States policy consistency, confusing allies and adversaries alike. United States are perceived as unreliable, betraying the abstentionist position. Bilateral talks suggest engagement over confrontation, potentially accelerating Venezuela's leverage. Geopolitically, bilateral talks aim to counter China's role as Venezuela's largest oil buyer while risking regime legitimization. Russia and Venezuela have been allies since the early 2000s under Hugo Chavez, a bond strengthened under Nicolás Maduro. Their partnership, rooted in shared anti-United States sentiment, spans oil coordination, military support, and diplomatic backing, making them interchangeable in the context of United States foreign policy pressure. Both nations collaborate on oil through OPEC+, influencing global prices. Russia's Rosneft has invested heavily in Venezuela's PDVSA joint ventures, ensuring mutual economic support. Their interdependence means United States sanctions on one, like Venezuela's oil sector, impact the other's ability to evade restrictions. Militarily, Russia supplies Venezuela with arms and advisors. This support bolsters the Venezuelan government against internal dissent and United States pressure, while Venezuela provides Russia a Latin American foothold, countering United States influence in the Western Hemisphere, a strategic concern for United States policymakers. Diplomatically, Russia recognizes Nicolas Maduro's 2024 contested election victory. This support counters United States efforts to delegitimize Maduro, such as recognizing Edmundo Gonzalez in January 2025. Russia's United Nations veto power further shields Venezuela from international sanctions, reinforcing their alliance. Venezuela reciprocates by supporting Russia's actions in Ukraine, abstaining from United Nations votes condemning Russia. This mutual diplomatic backing strengthens the resistance to United States pressure, highlighting the challenge of isolating either government without addressing their combined geopolitical strategy. The interchangeability of Russia and Venezuela means United States pressure on one affects the other. Sanctions on Russia's energy sector impact the Venezuelan investments. Targeting Venezuela pushes its government closer to Russia and China, necessitating a coordinated United States strategy. A maximum pressure campaign on Russia and Venezuela starts with economic sanctions targeting their energy sectors. For Russia, banning all oil exports to the United States and allies, per Bruce's Senate bill mentioned, squeezes revenue. Revoking Chevron's license cuts Venezuela's oil income, despite China's involvement. Diplomatically, the United States could isolate both countries by rallying allies. Recognizing Edmundo Gonzalez universally delegitimizes Nicolas Maduro, while expelling Russian diplomats from Western nations isolates Vladimir Putin. Regional pressure on Venezuela's allies, such as Colombia and Brazil, could further weaken the country's support base. Disrupting energy markets is key. Increasing United States and allied oil production lowers global prices per historical G7 price cap strategies. This reduces Russia and Venezuela's revenue, given their OPEC Plus coordination. However, China's role as Venezuela's largest buyer may offset this pressure. Targeting leadership directly involves asset freezes and travel bans on Vladimir Putin and Nicolas Maduro. The United States could expand sanctions on their inner circles, as done with Maduro in 2020, per historical Department of Justice indictments. Offering bounties for information leading to arrests has not destabilized their governments so far. Countering China and Iran, allies of both nations, requires secondary sanctions on entities buying their oil. United States naval presence in the Persian Gulf and Caribbean could interdict Iranian shipments to Venezuela, disrupting supply chains, though this risks escalating tensions with China. Challenges include Russia and Venezuela's mutual support. With Russia's military presence in Venezuela, complicating pressure. Global attention on Ukraine and Gaza limits United States leverage, while China's economic rule maintains both Venezuela and Russia, necessitating a balanced approach of United States pressure and diplomacy. Venezuela's oil industry in May 2025 reflects a shifting landscape post-Chevron exit, with PDVSA redirecting exports amid United States sanctions. OPEC's April 2025 oil market report estimates Venezuela's crude production at 900,000 barrels per day in March, rising to approximately 1 million barrels per day in May, per PDVSA's claims, aligning with export data. A detailed export breakdown follows. The United States imported 149,000 barrels per day the week of May 23, 2025, per United States Energy Information Administration data, down from 250,000 barrels per day in January, totaling 4,470,000 barrels for May. As a result of 149,000 barrels per day multiplied by 30 days adjusted for post-May 27th cessation. This 52 million weekly revenue was critical before Chevron's exit, after which imports likely ceased. China is Venezuela's largest buyer. China imported 428,000 barrels per day in April 2025, increasing to 450,000 barrels per day in May, following Delcy Rodriguez's May 1st visit to secure more purchases. This totals 13,500,000 barrels, underscoring China's key role in Venezuela's sanctions-driven market reorientation. India received 64,200 barrels per day in April 2025, growing to 70,000 barrels per day in May due to rising demand, totaling 2,100,000 barrels. Europe saw 100,000 barrels per day via Blend 22 exports, totaling 3 million barrels. Malaysia took 50,000 barrels per day, totaling 1,550,000 barrels, with a 920,000 barrel Boscan cargo transshipped, while other markets received 158,200 barrels per day, totaling 4,904,200 barrels. Cuba, a historical ally, received 30,000 barrels per day in May 2025, down from 56,000 barrels per day in 2023 due to Venezuela's refinery outages. Cuba's monthly export volume totals 930,000 barrels, reflecting strained energy support amid domestic shortages, impacting PDVSA's commitments to allies despite higher overall exports. Yet, Venezuela's overall exports reached 1,007,200 barrels per day. Iran supplied 35 million barrels of condensate since 2021, aiding heavy crude exports. Concurrently, naphtha imports rose to 94,000 barrels per day in April 2005. Oil prices dropped 23% since December 2024, with Venezuelan crude sold $35 per barrel below Brent benchmarks, exacerbating economic strain while exports increased. PDVSA faces rising shipping costs, with freight rates up 15% in 2025 due to sanctions-related risks. This increases operational costs by $5 per barrel, reducing margins and forcing PDVSA to prioritize high-value markets like China and India to sustain revenue. This export shift highlights PDVSA's reliance on intermediaries to evade sanctions, successfully targeting Asian and European markets. Production has risen in May to 1,007,200 barrels per day due to a successful pivot to China. Declining prices, logistical challenges, and rising costs threaten financial stability, pushing Venezuela to deepen ties with non-Western partners. Sanctions limit access to advanced drilling technologies. Chevron entered Venezuela in 1923 through its legacy company, Venezuelan Gulf Oil Company, establishing a century-long presence. In the 1990s, it formed joint ventures with PDVSA, including Petroboscan in Zulia, Petro Independiente in Zulia, Petro PR in Anzoátegui, Petro Independencia in Monagas, and Loran in Delta Amacuro. These partnerships allowed Chevron to tap into Venezuela's vast oil reserves. Chevron contributed to 25% of Venezuela's oil output, producing around 200,000 barrels per day at its peak. Its technical expertise was crucial in maintaining aging infrastructure, especially in the Orinoco Belt's extra-heavy oil fields. Chevron's investments in upgraders ensured the crude was marketable despite Venezuela's economic and political instability. United States sanctions in 2019 were designed to promote regime change and restricted Chevron's operations, targeting PDVSA. A license issued in 2020 allowed limited activities, and it was later expanded in 2022 under Biden as a General License 41 to permit exports to the United States. Chevron exported 290,000 barrels per day before Trump revoked General License 41 and substituted it with General License 41A, General License 41B, and the current Confidential Specific License. Economically, Chevron supported local communities, particularly in Zulia, through jobs and higher salaries than PDVSA. Petroboscan employed thousands, with bonuses fostering commerce in oil towns. Local suppliers benefited, creating a ripple effect that stabilized communities amidst Venezuela's broader economic crisis, making Chevron's role significant beyond production. Trump's revocation of Chevron's General License 41A in March 2025 forced a wind down by May 27th through General License 41B, halting production and shifting Chevron to maintenance and PDVSA joint venture emphasis with a new specific confidential license. This decision reflected United States efforts to isolate Venezuela, but reducing Western influence in the country's oil sector, impacting both the industry and local economies. Chevron's exit marks a turning point, opening opportunities for China, Russia, and Iran to expand their influence. PDVSA assumed control of Chevron's joint ventures, including Petroboscan in Zulia, Petro Independiente in Zulia, Petro PR in Anzoátegui, Petro Independencia in Monagas, and Loran in Delta Amacuro, after General License 41B expired on May 27, 2025. As the majority stakeholder, PDVSA now oversees production, worker management, and export sales. This shift marks a return to state dominance in Venezuela's oil sector. PDVSA plans to maintain PetroPR's output at 105,000 to 138,000 barrels per day, redirecting some crude to domestic refineries to address fuel shortages. It modified PetroPR's upgrader to produce feedbacks like vacuum gas oil, a strategy used during past sanctions in 2020. PDVSA shifted export focus to non-United States markets, with China importing 428,000 barrels per day and India 64,200 barrels per day. In April 2025, PDVSA introduced Blend 22, a new crude grade, targeting Europe and Asia. A 920,000 barrel Boscan cargo was shipped to Malaysia, a trans-shipping hub for China, evading United States sanctions. Dependency on diluents for heavy crude exports increased NAFTA's imports to 94,000 barrels per day in April 2025. Iran has supplied 35 million barrels of condensate since 2021, but sanctions complicate this supply chain. PDVSA's reliance on external inputs highlights vulnerabilities in its export strategy under United States sanctions. Infrastructure maintenance is a significant challenge for PDVSA, lacking Chevron's technical expertise and financial resources. Aging oil fields require substantial investment, which PDVSA strives to secure despite United States sanctions. Security concerns persist as 60 attacks on oil facilities have been thwarted in 2025. Chevron's operations in Zulia through Petroboscan provided economic stability, employing thousands with salaries and bonuses higher than PDVSA's. This supported local commerce, benefiting suppliers and businesses in oil towns. Chevron's presence fostered community resilience in a region heavily reliant on the oil industry's economic contributions. The exit threatens Zulia's poorest communities as reduced economic activity could exacerbate poverty. Job losses and lower wages under PDVSA are expected, as the state company may cut bonuses previously offered by Chevron, directly impacting household incomes and local economies. Local suppliers and businesses face financial strain as commerce declines in oil-dependent towns. The loss of Chevron's contracts has disrupted supply chains, leaving small businesses struggling to survive. The economic downturn threatens Zulia's social fabric, with families facing increased hardship amid Venezuela's broader crisis. The ripple effects extend to education and healthcare, as reduced incomes limit community resources. Schools and clinics, already underfunded, may see further decline, worsening living conditions. The socio-economic fallout deepens Venezuela's humanitarian crisis, with Zulia's vulnerable populations bearing the brunt of Chevron's departure and PDVSA's takeover. Abstentionists and virtual terrorists are blamed for undermining efforts to address economic woes, leaving communities without effective advocacy or solutions to their plight. The socio-economic fallout in Zulia highlights the human cost of geopolitical decisions. The potential for protests or increased migration looms as residents grapple with economic hardship, underscoring the urgent need for policies that address the needs of oil-dependent communities in Venezuela. Reduced oil revenues exacerbate Venezuela's economic crisis, limiting funds for imports of food, medicine, and other essentials. This deepens the humanitarian crisis, with inflation soaring and poverty rates rising, threatening social stability. Communities struggle to access basic goods and services. Maurel and Prom, a French oil company, holds a 40% stake in Venezuela's Urdaneta West field, producing 6,500 barrels per day in 2022. Its license was revoked in March 2025, with a wind-down period until May 31st, 2025, as reported by oilprice.com, impacting its operations. United States sanctions led to a 15% drop in Maurel and Prom's share price, reflecting market concerns about its future in Venezuela. The company faces penalties for non-compliance, forcing it to navigate a complex regulatory environment while engaging with United States authorities for potential new authorizations. Limited operations continued, with Maurel and Prom receiving Blend 22 cargoes in April 2025 for debt repayment, as per Reuters. This debt repayment mechanism allows the firm to maintain a minimal presence, but sanctions restrict its ability to expand or invest in Venezuela's oil sector. European firms like Repsol and Eni contribute 10% of Venezuela's oil production. They provide technical expertise, yet their activities are curtailed by United States secondary sanctions, limiting their operational scope. Chevron's exit signals a hostile environment for Western companies, deterring future investment in Venezuela's oil industry. The departure of major players like Chevron reduces competition, potentially leaving smaller firms like Maurel and Prom to either adapt or exit, further isolating Venezuela's oil sector. Maurel and Prom's uncertain future underscores Venezuela's reliance on state control and non-Western partners like China. As Western firms retreat, the oil industry's dependence on PDVSA and foreign allies increases, highlighting the broader challenges of operating in a sanctioned and politically volatile environment. PDVSA now controls export procedures from Chevron's joint ventures, focusing on non-United States markets to evade sanctions. This includes managing production, transportation, and sales of crude grades like Boscan and Blend 22, introducing new challenges in maintaining efficiency. PDVSA targets China, Europe, and India for exports, using transshipping hubs like Malaysia to evade United States sanctions. This strategy ensures export continuity, but relies on intermediaries. Logistical challenges include securing tankers and navigating international waters under sanctions. Tanker fleets operated by China and Iran help PDVSA bypass restrictions. Payment uncertainties lead to discounted sales and barter deals, with Venezuelan crude sold $35 per barrel below Brent benchmarks. Revenue is reduced as buyers exploit Venezuela's sanctions-induced vulnerabilities. United States secondary tariffs include a 25% levy on Venezuelan oil buyers. PDVSA learns to thrive on sustaining exports under a sanctioned environment.